Hello, everybody. My name is True Demon, and I am the Devil Stockbroker. This is going to be a quick update on the market in order to give you guys a heads up of what I anticipate going on for next week and a recap of what occurred this week of January 23rd, 2023. So, first, looking at the SPY, we can see that the S&P has broken through the top of its megaphone pattern and is now trying its very hardest to break to a new level of support. Right now, the S&P is above its first level of support at $400. This is a strong area of resistance that it managed to break through on the last two trading days of the week, Thursday and Friday. And it's now hit a top near $408 and is experiencing a slight retracement here. Right at the end of the day, we're now in the post market just a few minutes after the bell. And it does look like the market is beginning to show signs of weakness. A couple signs of that were a handful of bearish divergences on the RSI, which you can see here, where the market is putting in higher highs on the price action, but lower highs on the RSI. We had another breakout that occurred on Monday when the market surged, following up a big recovery that occurred on Friday, January the 20th. And the market has been trying to push through all these new levels of resistances on a repeating basis. What we expect to see now is for one last push from the market, either to get stopped at 408 sometime next week or to possibly challenge 412 before getting stopped by this significant level of resistance here between the price levels of 409 and 415. The absolute star of the market this entire week has absolutely been Tesla. Tesla actually broke at one time 12% on the day today. It closed at around 11% gains on the day. Tesla was by far the most impressive ticker on the S&P, and it certainly helped pull the entire market up. There's a few other tickers that we'll go over in this video, but I did want to call out Morningstar, who's a member of the Hell's Trading Floor Demons group, who attended our Sunday meeting where I had called out Tesla near at the top of this inverted head and shoulders pattern when Tesla had retraced back from $132 down to around $129. And I pointed out this inverse head and shoulders and anticipated a breakout of this bear flag to the upside where we would see Tesla hit somewhere around the price level of 160. Tesla beat all of my expectations and actually went all the way up to $180. And here's a clip of that just to prove that I'm not making this up. Okay, Tesla is looking really interesting. It's been at the bottom of its chart, and just like I said, that inverse head and shoulders, it popped right as it completed that inverse head and shoulders. Now I'm feeling really good about Tesla coming back up to retest 160. Everybody is counting out Tesla and saying that it's performing absolutely terribly. If Tesla comes out with a rock and roll earnings report and surprises the hell out of everybody, which I think they might, because they have been putting out more production more aggressively than usual. And I'm seeing more and more and more Teslas on the road than usual. I think that people are switching over to EV because of the tax credit. And I think that Tesla in particular is one of the more attractive vehicles. And now they have their cheaper, more affordable version. So if people are going to buy a sexy new electric vehicle, they're probably going to want a Tesla. I especially want to call out Morningstar, who, as I mentioned, is a new member of the Hell's Trading Floor Demons tier. And he actually timed this damn near perfectly, grabbing calls of Tesla right at $116 just after it had bounced off of the tip of the inverted head on the head and shoulders. Congratulations, dude. I hope you managed to time the top because that was a phenomenal trade. Let's go ahead and review what's going on elsewhere in the market, specifically in housing. The XLRE index, which is the S&P's real estate REIT collection ETF, has been showing itself to be in a continuous bear trend. And after a big rally in the market, moving up almost 12% in just 40 days, XLRE is getting very dangerously close to its 200 period simple moving average. It's actually right there, and we've even seen a clear rejection off of it with this wicking candle. What I anticipate is for XLRE to see a big rejection off of that $40.50 level, possibly making it up to around $41.25 before seeing hard rejection, and we see the market continue to plunge. The reason why I believe this is because the last time that XLRE approached its 200 simple moving average was right here on the 15th of August, just as the market had peaked after its summer rally, and then we saw a deep plunge in the overall market, especially in real estate, down 27% in just 2 months. Right now, I'm still anticipating a top in the market. I'm just waiting very cautiously on the side before making the execution. However, I have called this out at the beginning of the week during our last meeting on Sunday, where I spoke to the Demons of Hell's trading floor and called out that the market was appearing very, very close to its top. It was suggested to get an entry on a short position early, which if some did, then I apologize. It does look like we're a little bit early on that play, but still all the same, getting very, very close to a top. And if you're anything like me with your trading strategies, then you like to slowly step into your positions rather than go all in the first at the first execution. So keep a close eye and note that my target for this play is taking us all the way out till either the end of May, or I'm sorry, end of March or mid-April for any expiring options short on XLRE or its long on its inverse DRV, which you will note that we are currently sitting just below a significant level of inclining support and also at a significant level of support here at $40.80. If DRV gets a big bounce here, then I anticipate a very similar move to what we experienced during August and September of 2022, where the market lunges on the real estate sector and we watch DRV shoot for the moon. My main reason for believing this is because, one, for the data that is now considered public and open for retail traders to look into, the median sales price of houses sold in the United States has stalled out at $467,000, which is about level with what we had experienced in the second quarter of 2022. Keep in mind that this data is extremely lagging, and unless you're getting access to other real estate data providers, then you're not going to see this as a retail investor. However, all of the bigwigs on the banking sector and in the real estate sector are paying attention to numbers which are much more timely and are suggesting that there is going to be a massive decline in median sales prices of houses sold in the United States, as well as houses sitting on the market much longer. You can get this data for yourself if you go to the website redfin.com/news/data-center. The Redfin News Center gives you access to timely housing market data, which will let you know what's actually going on a more timely basis. For starters, if you take a look at the new listings on Redfin according to all metro areas of the United States, you'll notice that right at the very end of December, beginning of January, you start to see this big surge of new listings entering into all the metro areas. This is a yearly occurrence that it's a very seasonal thing in the real estate market, where new homes get put out onto the market at the very end of winter, very start of spring, in order to prepare the homes for viewing and get new buyers to buy just going into the spring season. This is the most popular selling season to get your home onto the market in order to capture the best price. And you'll notice that we are experiencing the exact same thing here in January 2023. We started off very, very slow, but the new listings are increasing significantly. And you can see that we've now got approximately 50,936 listings across the U.S. housing market. However, one thing that is very different about this particular housing market beginning start of this year is that last year in 2022, we had seen a rise in median sales price going through January, February, and March. For the first time, the year is starting out very slow with the median sales price in continuous decline all the way through December. Now, we still need to get numbers from January, but if we see the first month of this housing market season end in a decline, then that's going to be a signal of the rest of the market to come, because one thing that nobody is talking about is how homes are now sitting on the market for an average of minimum 30 days and as long as 60 days on the market. And this is a trend that has completely broken all the past 2 years of data where homes were sitting on the market for just a few days before they got into bidding wars and scooped up off of the market. This drastic change is a signal that the housing market is now at a point where it's preparing to collapse and that the bubble has popped. At the same time, the other piece of data that is most critical to what is happening in this market is that while it is still technically cheaper to rent property than it is to own and mortgage property, look at the incline of the cost of mortgages in the United States right now. Monthly mortgage costs have skyrocketed from an average of $1,250 in December of 2021 all the way to an astronomical $1,831 ending June 2022. This sharp rise is not only going to hit homeowners hard, it's also going to hit renters hard because it's going to put all of the rental property owners in a position of being forced to raise rent in order to offset their costs. And the ones who cannot raise their rent anymore, either because of state laws on rental hike restrictions or simply just cost prohibitiveness because of local competition, this is going to put all of these rental property owners in an untenable position where they are either underwater in their rental property ownerships or they're barely breaking even, and therefore it's not worth the stress and the cost to their time in order to keep holding on to the property and trying to make the business work. This is going to put them into a position where it is much more desirable for them to just sell and get out of it. When this happens, it's going to happen all at the same time because this is going to hit everybody all at once. This graph should absolutely scare everybody because it doesn't just affect the homeowners, it affects the renters as well. Anybody who's currently renting, you've probably already experienced some pretty stiff rate hikes in your area. I know I have. For that reason, everybody should anticipate seeing a big downturn in the housing market starting in spring. By March, I have no doubt that all of the news is going to be printing out how prices of homes has collapsed and that the market has finally ended. By that time, it'll be too late to make the moves. So, for that reason, I'm getting into my DRV position starting this week, and I'm going to be playing the market all the way out till the end of April, expecting a big drop in the XLRE index, which, if you are trading inverse ETFs, will translate into a rise in DRV. And my price target sits here at a very lofty, but I believe very attainable $75 price target. Looking at the SPY and the high yield grade bonds index, I am comparing these two ETFs in order to illustrate a discrepancy in the market and also in order to call the tops. One of the first things that always seems to happen right before the market has a big downturn is the HYG will diverge from the SPY. This divergence occurs when the S&P continues to create higher highs, but the HYG creates lower highs. And this has happened now for the first time so far this year. So right now, while the SPY is currently in continuous rise, the bond traders, aka the smart money, are starting to see some doubts. For this reason, I think that we are very near the top in the market, so I'm going to be looking at other tickers which are overbought in order to make an advantageous short position. The first ticker on my chopping block is Netflix. Netflix has traded its entire gap where it resurged all the way down from its lows of $200 and recovered well past $338, which was the beginning of its big gap that saw a huge drop in a single day of nearly 32%. Now that Netflix is back above this gap, while it has traded significantly above it for an extended period of time, I believe that Netflix is still extremely overvalued. And now that it is in this zone of resistance that I have marked out here, I anticipate that Netflix is going to start to see some more weakness in the market. On the first sign of RSI bearish divergence, that's when the price creates a higher high and the RSI creates a lower high. I'm going to anticipate a big turnaround in the market to the downside for Netflix. Another sign of this, if you don't use RSI, is a second cross down outside of this price cloud for Netflix on the MACD. If you at least know what you're doing with technicals, you should be able to spot these cross downs in MACD and take note of this big surge of strength creating a lower high for Netflix all the way going back to October of 2022. Lower highs all the way down. And now we have our first higher high on the MACD here, but still lower than this high. For me, I'm going to wait until I see a very clear rejection from Netflix off of some point in this zone of resistance. It could have been starting on Thursday of this week, but we may see yet another high at around 380 in the near term. Once I see clear rejection from any of those points, along with other tickers moving down in the market simultaneously, I will take that as my signal to enter my short position. Another one that I'm looking at is Nvidia, which I believe was overbought for a significant period of time, especially since its last earnings period, which saw Netflix kind of bounce around and try to take a new high before it got rejected by its 200 period simple moving average. Netflix has since made quite a big recovery in this bear market, but I still believe that it's extremely overbought because right now Nvidia is pouring all of its money into quantum technology and their partnership with Microsoft, and they are not making up for any of that expenditure with sales in their graphics card market. Right now, semiconductors are extremely expensive, and that's translating to an extremely high price tag for Nvidia's latest line of graphics cards, which sales of are abysmally low. This is exacerbated by the issue of the crypto collapse, which is causing a bunch of Bitcoin and other crypto miners to sell all of their graphics cards to the aftermarket in order to recoup some of their losses. This aftermarket is creating a surge of supply in graphics cards right now at extremely cheap rates. And all of these are used but extremely good graphics cards. And that's creating a big competition with Nvidia because their own products are being sold used at much, much cheaper price tags. In many cases, half price of what the market value of Nvidia's graphics cards are fresh out of the box. By the time that Nvidia hits another high at around, I'd say 215 at the absolute highest, it will have hit this area of resistance right here and get a strong rejection back to the top of this descending wedge that has been forming on Nvidia since approximately November of 2021. For the financial sector, I'm paying very close attention to JP Morgan Chase. JP Morgan Chase is one of the biggest banks on Wall Street and also the biggest holder of derivatives in the entire financial sector. They hold more derivative assets than any other bank combined. Because of that, JP Morgan is particularly exposed to the mortgage-backed securities market. These are essentially bonds on mortgages that derive their value from people paying their mortgage payments in a timely manner. With this new problem in real estate, a whole bunch of people are starting to go underwater on their mortgages, especially institutional investors who use mortgages in order to buy up all this property and are going to just flood the market in order to get out of this property at probably substantial losses. Once all those houses go onto the market, it's going to collapse the price of all these homes in the market. And it's going to be a race between institutional and individual investors in property to get out of these properties the fastest. The ones who get out the soonest with the minimum losses is the winner, but there's really no winners in this situation. Everybody's going to get hurt by it. At the end of the day, people who are left holding the bag are going to start to default on their payments because they're not able to sustain paying for a property that they either do not have renters for or they cannot raise the rents high enough to pay their own mortgages. Once this starts to happen, you're going to see a whole bunch of default waves hitting the housing market, and that's going to translate to a loss of profit in the mortgage-backed security holders, namely JP Morgan Chase. This is already beginning to happen, but it's especially going to start happening in droves once everybody becomes aware, broadly speaking, in the real estate sector, and that's going to translate to a big drop in equity and derivatives for JP Morgan Chase. And not that I think that JP Morgan is going to collapse itself, but because I think that they are a barometer for the rest of the financial sector. If JP Morgan Chase starts to get sick as a company and you see a big drop in their price, then you're going to see many other banks begin to suffer also. So I'm going to be closely watching JP Morgan for its first sign of weakness before choosing to go short on it and other sectors or other major banks in the financial sector, such as Morgan Stanley, Bank of America, and Goldman Sachs. And then last on my list, I have Apple, which you've noticed has been kind of struggling a bit as it's approached its 200 period daily simple moving average. Every single time that it's been rejected by it, it was subsequently rejected by its 200 daily exponential moving average, and had this ceiling that it couldn't break past before eventually it had a big dropout. Now we're starting to see a very similar setup. One thing to be very careful of is that this does have the potential to work out like a cup and handle, so don't get into a short position too early, but instead watch very carefully for continuous rejection and for it to break its level of support here at $138. Once Apple breaks this level, or if earnings are particularly bad, then anticipate Apple to collapse and start to retest these lowest lows. I want to wish everybody the absolute best of luck, and I look forward to seeing you in the next video. But until then, a hell of a time in the markets.